Hey everybody, this is Brant. How are we doing this morning? Sorry, it's a Sunday morning, a little bit late notice on this live stream, but we had some things going on this weekend and schedule change. So I'm here with you now. And let's see, who do we have? Anybody up here? Mario. Hey, cheers, Mario. Thanks for that Apple warning about the earnings. I appreciate that. Okay, so let's get started. Yeah, trying to keep this relatively brief for your Sunday, and we're going to take a look at a few of the averages. First of all, um, they all look pretty similar here. So we're looking at the S&P 500 on a 30-minute chart, and you're seeing like a lot of rectangles. So a rectangle, it's not surprising actually in earnings season. Earnings season's a little bit dull. Wait until you get to Q2 earnings season in the summer doldrums. It's like, kill me now. In any case, the S&P 500 is actually a little bit of an upgrade on the week because this did look like it was turning into a small head and shoulders top, which if it had made a lower high right over here, it would have been, and that would have been back here by the February high. Then you'd have the potential of a double top coming in. So a little bit of an upgrade for the S&P 500 on the week. But again, we're in this rectangle. So this is kind of like a balance between the bulls buying down here and the bears selling up here. It's kind of an equilibrium in a fairly low conviction environment right now. Being that we're in earnings season, we just got through with one of the biggest weeks of earnings season. I think 45% of the S&P reported. So let's go to the next one, the Dow, and you're going to see the exact same thing, another rectangle. So another point of like equilibrium between the bulls and the bears. And in this case, the Dow, you might recall, let me go to a 2 hour chart. You might recall the Dow actually led this rally from October lows. And let me see if I can stretch this chart out a little bit back here. And it gained 20% and then it did nothing. So we get into these big symmetrical triangles. A symmetrical triangle is kind of like a rectangle in that it doesn't have an inherent bullish or bearish bias on its own. And okay, B Red, I wonder if you would share your risk management with us on the chat. I think that was pretty, or Brett, I think it was pretty, really amazing. It made my week to see it. In any case, the Dow did nothing, right? Gained that 20%. Financial media saying, oh, we've got a new bull market, all that stuff. And it really wasn't. It did nothing from there. So you can see where it topped out right here. So when a symmetrical triangle like this gets really big, over 3 weeks, over a month, there's just an increasing chance that it's acting as a top. And you can see price broke down. And then where do we have this little rectangle? It's right there at the apex. So again, kind of almost a little bit of a toppy formation there, but let's go back to that 30-minute chart and we'll go to the next one. Hope you guys can see all this okay with my mug on the screen. You know what? Let me take my mug off the screen and then we won't have to worry about that. So here we go. Okay, so the next one up, NASDAQ 100, right? NASDAQ 100 actually outperformed a little bit on the week, up 1.9% versus 0.9% for the S&P 500. So 100 basis points in outperformance. Again, you can see this rectangle, but what I want to point out is the change in character, the change in tone. Now, a lot of it could just be earnings season, but if we do look back at the NASDAQ 100, which rotated into a position of leadership, Q1 started this year, January, from being like the worst performing stocks of 2022, right? As rates went up and their forward looking valuations, which were quite high, had to be discounted. So you can see here in January, that rotation, there's January 3rd, first trading day of the month, and NASDAQ took off. It was the leader, bull flag. So if we go back to that 30-minute chart, that was the big bull flag here. Look at bull flag, bull flag, bull flag. We started right here with a bull flag and then came into earnings season and went into this kind of lateral rectangle range. So a little bit of a downgrade in the price action for the NASDAQ, but it's still looking pretty good. You had this little teeny head fake right here. And remember, what I always say is from failed moves, failed breakdown here, come fast reversals. So basically what the idea is, the shorts are jumping in right here. That move fails, they get squeezed, and often you'll see, I call these channel busters, even though this is not really a channel. But if you did have a channel and price dips below it, those shorts get squeezed when that move fails, and you'll typically see price run up and just above the top of that channel. So kind of what we're seeing over here. But the NASDAQ 100 does look good still, but you can see the change in character from nothing but bull flags from January to a rectangle. So a rectangle, like a symmetrical triangle, as far as consolidations, it has no inherent price bias. It depends on the preceding trend, which was up here. So we give it the benefit of the doubt because of that preceding trend. And hold on, I'm just checking everybody who's here. Adam, I knew you'd show up. I'm great, Adam. Thank you. Frank, everybody. Okay, cool. I'm glad you guys could make it on such short notice. So NASDAQ 100, and then we have the IWM small caps. I use IWM instead of Russell 2000, just because I don't want to pay extra money for the data feed on Russell 2000 when I got IWM. So what we did see here, or what I saw here, was the potential. This is the SVB meltdown. So small caps have a lot of exposure to the small regional banks. So they got hit here. And you can see kind of this change in character from what was a bull flag in February. Remember, we had a lot of hot inflationary data in February, and we got some, like month and a half consolidation. So here's that SVB meltdown. And then what looked like a left shoulder here, a head here, and a right shoulder here. So when you're looking at head and shoulder tops or an inverse head and shoulder base, the volume confirmation is really important. So that's the way you can distinguish it from just a random price pattern. And if we look at the volume on IWM, hopefully this comes out okay. You can see it. It looked really good at this first right shoulder, heavy volume, right? And then at the head, actually a little bit even heavier volume. Let me go to a 60-minute chart. Maybe the volume will show up a little bit better. So you see that high volume, that's like capitulation volume. So that's what you want to see. Big selling volume here, capitulation, seller's exhaustion there. And then on this first rally up to the neckline, you want to see volume expand, which we saw a little bit right over here. But on this right shoulder, what should happen is the volume, the rally volume, should expand even more notably, and that didn't happen. So I pointed this out, I think in last week or the week before, live stream, and that was a little suspicious. Got up to that neckline, pulled back. What I don't like about IWM, now there are like asymmetrical kind of inverse head and shoulders or head and shoulders tops, where instead of just getting one shoulder ahead and another shoulder, you might have two right shoulders. Usually they tend towards symmetry, but those are called complex head and shoulders tops or bottoms. But when this happens, when you make a lower low below this right shoulder, that's not a great sign. And the fact that we didn't have great volume here, again, not a great sign. So is it a failed move? No, but I wouldn't call it an inverse head and shoulders base. And the reason for this is the regional banks, when they reported earnings, something interesting happened. First we had First Republic that the market was watching, and First Republic actually had decent earnings, and they confirmed that the outflows that they had, the deposit outflows from March, kind of subsided at the end of March, and they saw some inflows coming back in April. But it was the extent of the deposits they lost that really spooked the market. So if we look at FRC, First Republic, I mean, this is just an absolute mess. You can see what's happened here after earnings, and it's an ongoing drama. So they're losing fund managers. They're talking about selling assets to repay back the Fed short-term loans. And The FDIC suggested that they might be cut off from Fed funding. So the FDIC and the government, I think, is really trying to force like a private solution where the big banks come in, because if, FRC, First Republic, goes down, those big banks have assets there. They're going to feel it too. So they're trying to force that. And then we had Pacific West that actually confirmed kind of the same thing, right? So they confirmed that they had deposit outflows in March, but they kind of subsided towards the end of March, and then they saw some inflows. But it's the ongoing drama in FRC that's keeping these regional banks from rallying. This was like maybe a really sloppy, poor example of an inverse head and shoulders breakout failure. So it's just a mess. The way you could also look at this too is like a bearish descending triangle. So they're just kind of a mess. The KBW Bank Index looks just a teeny bit better, but not a lot. In any case, let's get back to IWM. So we'll just have to watch it. I think this pattern doesn't look as good as it should, or as it did at this point once that volume wasn't there. So very, very important. Don't just go by the price action and say, well, that looks like a head and shoulders bottom or head and shoulders top, but confirm the volume. That is probably just as important as the price action. Let's go on to the next thing here. What do I have for you next? The mega caps. So the mega caps rotated in at the start of Q1 of this year, and they just blew everything away, right? NASDAQ gained over 20%, just like the Dow gained 20% in that October to November rally. And we're going to take a look at a couple of the sectors. So the most heavily weighted sector, by far, technology. And let me zoom out a little bit. So again, technology rotating in at the beginning of the year. Here's January 3rd. Massive rotation in. So we actually saw some tax selling and stuff like that in December because these were such poor performers. But you see this big bull flag, right? And if we come in closer, you see bull flags over here. And we have a bull flag over here that's starting to break out. Again, look at that little head fake or a little bear trap, and price moves above. But the other mega cap indexes are the other S&P sectors that have really heavy exposure to mega caps, like consumer discretionary. Now, let me tell you right now, consumer discretionary is a cyclical, but because of Amazon and its weight and Tesla and its weight, it acts a lot more like the other two mega cap heavy sectors, which are tech and communications. So there is the consumer discretionary sector. You can see it does not look as good as the tech sector. Doesn't look horrible, but does not look great. And then we'll go to communications, which has got like Alphabet and Facebook or Meta. Looking a little better, right? And then let me take you to the actual mega cap index. Now there's a lot you could use. I use MGK just to be consistent with you guys. So when I'm looking at how many basis points mega caps are outperforming or underperforming, I just want to keep it consistent. So that's why I use MGK. So again, coming into the start of the year, right over here, January 3rd, rotation in, these mega caps led. February hot data, we got a bull flag. We didn't get nasty price action. I mean, it's bigger than I would like, but considering what was going on in February, where the market was starting to freak out about resurgent inflation, really acted well. Got a little kind of wedge or pennant over here, which is bullish. You can see the bull flag, bullish wedge or pennant, and then we come into a rectangle. So as far as changes in character, this is what I say all the time. Changes in character precede changes in trend. Now, the fact that you have a change in character doesn't necessarily mean that you're going to see a change in trend. But, and stick with me here, if you do have a change in trend, it's almost certainly going to have shown a change in character before that change in trend happened. So for, people who are wondering, well, what does Brand do all day? This is what I do all day. So these kind of things you see intraday. If you're looking at daily charts, sometimes you miss these, or if you can't watch the market every minute of the day like I do, you miss these things. So those are some of the really important things. They're not the big ones that stand out that everybody sees. Like, we tested the 50-day and it held. Everybody sees that. Everybody knows that. But these changes in character from bullish consolidations to this is a slight downgrade. So we do see mega caps breaking out, and they did outperform on the week. So as we're going through earnings season, there was, I think, a possibility that the banks could have given the market some comfort and said, we're out of that mini banking crisis from March. You can go ahead and get that relief rally in. But because of the ongoing drama with First Republic, we just didn't get there. So it seemed like in this past week with the mega cap earnings, the market has decided, let's go back to these secular growth that aren't as dependent on the economic cycle, like the cyclicals, like energy, materials, industrials. Again, consumer discretionary is a cyclical, but it performs a lot more like the mega cap heavy sectors. Let me just take a look at the comments real quick because I'm seeing a lot. Okay, B Rent, thank you for sharing that. It closed my IW in position. Getting back to my sell price, right shoulder to preserve capital. Yeah, excellent. I was so happy for this. So, you would think, oh, somebody stopped out and whatever. Look, if you're in the market, it's like you have to anticipate, you have to expect that you're going to have trades that don't work. If you have really tight risk management, like B-Rent is telling us about here, and we had a couple of exchanges back and forth on email, I was so thrilled to see how tight his risk management was. And I said, if I could have the most successful, highest probability trading system, but no or poor risk management, or I could pick stocks by throwing a dart at a dartboard, but have bulletproof risk management, I would go with the dartboard and the bulletproof risk management. So it's kind of like, don't be afraid to take a loss. Don't be afraid to cut a loser. But it's actually his risk management, his 2% rule that he went by. That was I was so thrilled to see that because, if you're really consistent about that, you are going to do well in the market. It only takes 1 or 2 times of slipping up and not being consistent to really just destroy your portfolio. So I was really happy with that. Thank you for sharing that, Brent. And maybe if he consents, I'll share the emails for the members in one of next week's posts. Mario, and you point out the charts where the change in character maybe you did it and missed it. You point out on the chart change in character. Okay, so change in character. Let's go back to the NASDAQ real quick. NASDAQ, the change in character really is from these very bullish advance, very bullish consolidations like this big bull flag. If we go in closer, you get small bull flag, small bull flag. This is just bullish price action. The pullback consolidation, it's been bullish since the first of the year. So a rectangle still has a bullish bias, but it is not as bullish as what we had before, which was something more along the lines of, let me get on a little different chart here and I can draw it in. Let me get rid of this. But what we had before was more along the lines of a bullish ascending triangle. This is going to be real sloppy, guys. I'm just going to put this in real quick. But what we had was something more akin to a, get rid of that, a bullish ascending triangle. And I'll tell you why. Oh, gosh, butterfingers this morning. So it looked like this. So when you have a rectangle, you're basically looking at equilibrium between the bulls and the bears. The bears are stepping in here, the bulls are stepping in here. It's kind of equilibrium, gets the benefit of the doubt because of the preceding uptrend. But when you have an ascending triangle, what you actually see is a point of resistance here, but every time the market pulls back, the bulls are stepping in a little bit earlier and they're causing this lower trend line to rise. So this is a more bullish price pattern that we basically lost last week. But this is still looking good. And then, like I said, the mega cap index did start to break out over here. So that's a good development. But there's a slight downgrade to the price action from what we've seen in most of this year from Q1. So I hope that answered that, Mario. If it didn't, let me know. Okay, so Adam, earnings too far from the mega caps getting seem to have been positive. So that's obviously positive for the market. Yeah. I think what the market is starting to see is that a lot of the cyclicals, and you know what, I could probably pull this up. Let me show you real quick. I'm going to pull up a different chart. Just give me a second to set it up. And I have a pretty much an equal weighted index of cyclical stocks. Just give me 1 second to set it up and I'll transition it over for you. Okay, so here we go. I'm going to transition this over for you to Stock Finder. So what you're looking at now is the S&P 500 and the candlesticks and a list index. Now this is an equal weighted list index of those cyclical sectors. So you could see how they led actually the rally that started in October, higher low over here, right? Whereas the S&P was making a lower low. So they actually led that, but now you can see coming into March, April, where they're really starting to underperform over here. Let me pull up the defensive sectors for you real quick. So the defensive sectors are going to be like utilities, consumer staples, healthcare is defensively oriented. And you can see how they're not doing really great right here. And when I start to show you the market breadth, this will make a lot more sense. And then let me just show you my own little mega cap index. This is just an equal weight. So I'm taking the cap weighting out of it. And what you'll see is, especially like this week, let me go back to that 60-minute chart. What you'll see is they're starting to kind of rotate back in. If we look at this little area over here, coming in earnings, they were kind of a little bit more skeptical or a little bit weaker, but they're starting to rotate back in after the last week. So I think the market has seen enough of the earnings that they're kind of deciding we want to go with these secular growth type stocks that are in the growth style factor rather than value. And they have, you know, huge bulletproof balance sheets, you know, especially as compared to something like the banks. All right, so we looked at KRE. I want to show you one other thing. Here we're going to go to a little PowerPoint presentation. I'm going to switch that over for you. Okay, cool, Mario. And I've covered this a few times, so most of you are probably pretty familiar with it. Just see what that's looking like. Okay. So what we have here, and you can get this from the St. Louis Fed's website, FRED. They have a lot of the charts there. What you're looking at is the effective federal funds rate in blue, and then the 2-year Treasury or Treasury yield in red. And what I've been pointing out is when you have a Fed rate hike cycle, like this one coming into 2019, and the 2-year yield crosses below the Fed funds rate, more often than not, especially over the last 20 years, that is the end of the Fed's rate hike cycle. So you can see the last rate hike over here, the cross under, and no more rate hikes, flat, and then they start cutting and we come into that COVID crisis. That gray line, or that gray area, shaded area, is recession shading. So if we look, you know, over here, the Fed funds rate up there at effective 4.75 to 5%, and we have the 2-year yield crossing below that. So historically speaking, especially over the last 2 decades, when this happens, it generally means that the bond market is saying enough, and the Fed typically listens. So there's always, you know, that mantra of don't fight the Fed, but the bond market also gives you a lot of insight, and it seems like the Fed pays attention to it. So I do think we will get a 25 basis point hike next week. That's pretty much a given at this point. but I'm not sure that we'll get much more after that. Actually, I don't think we'll get much more after that. I think it's getting to the point of diminishing returns when you kind of weigh rate hikes that are in the pipeline, because it usually takes about 6 months for them to hit the economy, versus the downside, which is, not the economy, but the financial system imploding. And I always say this, in order of what the Fed is most worried about and least worried about. They're least worried about a recession. They're more worried about inflation, but their biggest worry is the financial system, the plumbing in the financial system breaking down. So I do think that'll probably be the last rate hike from them. Now, what I think is interesting is the market has rallied basically from October in anticipation of basically first peak Fed hawkishness, which came along with peak inflation. I have a feeling that there's going to be a sell the news event when the market feels the Fed's done. I don't think it will necessarily be Wednesday. It could take a month or a couple months, the rest of the quarter, whatever the case may be. But I'm kind of leaning towards, if they do that and the market feels they're done and the S&P rallies maybe above 4,200 or something like that, my gut feeling right now is that institutional money, the big guys, are going to be selling into that rally. Their positions are so large that they don't just place a million share order. They would, crash the stock around themselves. So it's a process of distribution. That's what 3C is really about, trying to dig out that process. But I have a feeling it'll be a sell the news event. And that kind of lines up with my whole phase one, phase two, phase three. Phase one being the rally on the Fed pivoting, becoming less hawkish or peak hawkishness. Phase two is the recession part, and that's where I think the market will probably make a new primary trend, lower low, kind of restart that bear market. Okay. Next thing. So I talked about 3 market phases. So I think we're like late inning of phase one, which is the rally. So I think we're late 9th inning on that. But, that's a gut feeling. We'll just keep watching the charts. Okay, so I have a couple more things for you. Changes in character. So another change in character. What you're looking at here is a 2-hour chart. I'm looking at the comments. Yeah, I'll show you ABI. I don't have a scan set up for ABI right now that highlights the sub 14 levels, but what I'll do is I'll get that out in a subscriber post this week. It just takes a few minutes to set up, and I don't want to have you guys waiting around while I do that. But in any case, so changes in character, what you're looking at is the Dow Industrials, and in blue, you're looking at the Dow Transport. So remember, the industrials led the rally from October lows, and they were my favorite at that point. Okay, they were my favorite because they had the best base at that point. And you can see where the Dow does nothing else, after that rally, after it made its 20%. So you see transports going up here, but they're actually going up with the market as basically the mega caps step in and start to lead. So it doesn't look that bad from this perspective, but we're talking about very recent changes in character. So let me zoom in a little bit. Same chart, but this is a 30-minute and it's normalized. So prices are normalized as of this left area here on the chart. And what you can see, is transports really underperforming the Dow. If you go back to old Dow theory, transports and industrials should confirm. So industrials make the products, transports ship them. Now, the Dow is not as industrial as it was 100 years ago, but still, we tend to see the transports be more economically sensitive, and because of that, they tend to lead the Dow. Just like kind of semiconductors are more economically sensitive and they tend to lead the tech sector. So let's move on to the next chart. And what we have here is the technology sector and the semiconductor index, as I was just talking about, in blue. Again, it's normalized. You can see they start at the same price point. So the semiconductors, right, into January are leading the tech sector higher. So this is a bullish change in character at that time. But if we move in closer, because remember it's normalized, so wherever I start the chart from is where the percentage gains are going to start from. So over here, we're looking at a slightly shorter chart, 30-minute, right? The tech sector and semis, you can see a really notable change in character recently. So that's what I've been seeing recently, more and more with different assets, with market breadth, stuff like that. So I hope that makes some sense. If it doesn't, just let me know and we'll carry on from there. And next up, we're going to take a look at market breadth, another change in character. I'm going to have to switch over to Stock Finder. Let me set that up real quick. And we will start with the percentage of NYSE stocks that are trading above their 200-day moving average. So in the red and green candles, we have the S&P 500, and this white line is the percentage of stocks, NYSE stocks, trading above their 200-day moving average. Now, market breadth in this rally from the October low over here, you can actually see market breadth improve here. As we see the S&P make a lower low, we see market breadth make a higher low right here, and it's actually leading. So that was a positive change in character back in October when we were just still, everybody's kind of still saying, oh, we're in a bear market still. But as you see over here recently, not confirming. S&P is pretty close to those February highs. We're not confirming. Let me give you a little bit broader perspective just to show you how insanely strong this market breadth was. So over here, you're looking at the S&P's all-time record high. And this is what I was saying. Through all of 2021, you had a handful of heavily weighted mega cap stocks that were carrying the market. And the more we went through the year, the worse the market breadth got. If I had just looked at market breadth alone and I had no idea what the averages were doing, I would have guessed they were in a bear market. That's how bad it was. It's probably the worst I've seen in over 2 decades. So if you look over here into January, this particular indicator is way above where it was at all-time bull market highs. So it's still, fairly impressive, but there is quite a downgrade right over here. So that is one change in character in market breadth. And remember when I showed that chart of the cyclicals and the defensives, they're not keeping pace up anymore. It's kind of the mega caps that are coming back in. And that's something I anticipated, last year, late last year, when I expected the mega caps to rotate in. Money would flow out of thousands of these smaller stocks into a dozen of these bigger ones, and market breadth would deteriorate. That's fine. Mega caps can still carry the market, but the worse the market breadth gets, the more fragile it gets, and you're basically dependent on half a dozen or a dozen stocks to carry the market rather than thousands participating. And let's go to the next one, the advanced decline lines. This is pretty interesting. So first we'll start with the NYSE, and I'm just going to leave the S&P because the benchmark index, I'm going to leave that up as our comparison. And you can see not too bad, right? Tracking pretty much with the S&P. S&P has a slight lower low because remember we did hit 4,200 over here. So this is fine for me. But when you go to all of the stocks, not the NASDAQ 100, but the NASDAQ composite, all the stocks that are listed on the NASDAQ, what you'll see is market breadth really starting to come apart over here. Okay, so this kind of rally from the mid-March lows that brought us to where we are now, market breadth has definitely deteriorated. I can zoom this out a little bit more for you. And you can see, it tends to often lead. Over here at all-time new highs, this is a minor divergence, but you can see there were fewer stocks participating in the rally right there at all-time highs. And we're doing okay here, but this is now getting kind of ugly. So you look at where the S&P is up here, and you look at where market breadth is down here by those kind of late December tax selling area. So again, a little bit of a downgrade to that outlook. I'm going to take a look at the comments here again. Adam, yeah, these divergences always seem to play out in the end, which is worrying. Um, so I wouldn't be worried about it as long as you're on the right side of the market. So if you're not comfortable with selling short, I grew up, I came up in the market. I grew up in the market during a bear market, where I really got my most insights was during a bear market. And I've been through all of them since the dot-com crisis or dot-com bubble. I like trading bear markets. I really do because they move faster and deeper, quicker than you'll see in a rally. And their bear market rallies are sharper, stronger than what you'll typically see in a bull market. So I do like bear markets. It doesn't really matter. I just want to be on the right side of the market. So whether I'm trading long or short, it doesn't matter to me, just being on the right side of the market. So if you do have like a portfolio or retirement fund that you're a little bit worried about, there's ways to hedge it. There's ways to protect it. There's ways to participate in the bear market rallies if you prefer to go long. I'm not worried about that. I'm just more concerned about being on the right side of the market. So I think I've got those two guys down. And we're going to go back to that PowerPoint real quick. And I'm going to show you a couple other things. We're going to look at gold, Bitcoin. Getting a drink of water, sorry. PowerPoint, can I transition this? Why is this not coming up? Okay, here we go. I head faked myself because I didn't realize this chart was part of my PowerPoint presentation. So let's go down to the next slide here. And what you're looking at is gold futures here in the red and green candlesticks. It's a 2-hour chart. And you're also looking at Bitcoin futures in blue. So I guess over the last month, 6 weeks, something like that, I've been talking about it a lot at our member site, and I've also covered it a little bit in the videos. But Bitcoin and gold have been acting very similar, especially recently. First, we got an ascending triangle in gold right over here. It was the first to break out. Then we got an ascending triangle in Bitcoin futures. It followed the breakout with about a 7-day lag. We had this real sharp pullback in gold down to test 2000. That shouldn't have happened. And what I was telling members at the time was I feel like they broke out a little too early, right? But the point is, we get this breakout and this test that shouldn't have happened down to 2000. Bitcoin does the same thing, breaks out, does that test below 28,000. We got another test. I think we've had like 4 or 5 tests of 2000 in the S&P, but Bitcoin is basically, in gold. But Bitcoin recently is basically tracking what gold is doing with a 7 or 8 day lag. Here's the next chart, and this is just a closer view. So gold futures, again, Bitcoin futures in blue, 1-hour chart. You can see there's that ascending triangle, the breakout in gold. Here's the ascending triangle in Bitcoin futures, the breakout about 7 days later. So that's what I want to point out. But now I'm going to show you why I kept saying I think they broke out too early. You say price is always right. You don't argue with price, but that's not quite true. What we're looking at now is a 1-hour chart of gold futures, and this purple line is 2-hour treasury futures. So treasury prices move opposite treasury yields. So you can see pretty good confirmation. These two are moving together. So this means lower yields And what I think gold and Bitcoin were both representing when they started acting a lot better over here was the market's view that the Fed is getting close to ending their tightening. And at this particular point, what was happening was the banks were taking money from the Fed, and the Fed's balance sheet started to go up. So it's not exactly the normal where the market follows the Fed's balance sheet, because the Fed's basically injecting money via the banks. The banks are putting in higher yielding assets. It wasn't exactly the same as that, but similar. The Fed's balance sheet went up pretty notably, and we saw gold and Bitcoin coming up. So they're kind of reflecting this view or this hope that the Fed is going to stop hiking rates. The Fed is going to stop rolling off their balance sheet. Basically, the Fed is going to stop extracting money from the economy. Bitcoin is, for a fund manager, Bitcoin is a speculative asset. So it tends to do better when there's a lot of excess money sloshing around in the system. And that's just not the case now, but that was kind of the hope. So we see where gold breaks out over here. The 2-year treasury is not confirming. And this is why I was saying I think it was too early, and it probably is going to depend on what the Fed does. Let's move down to the next chart. And what you're looking at now is Bitcoin futures in the red and green candlesticks, and the 2-year treasury futures, same thing. Here's the breakout in Bitcoin. We're not confirming over here in the 2-year. Too early. The market just doesn't know until we get to the FOMC, and you can see that Bitcoin could not hold that breakout. So back below 30,000, back below 28,000, and we get this kind of little bump over here. It's kind of, again, tracking gold with a 7 to 8-day lag, more or less. But this is what I'm talking about right here. I think it was just too early for them to break out. And let's go to the next one, the dollar index. So I've warned about this as long as I've been doing this, I think. I've warned that you have to be wary of the Federal Reserve meeting and stocks' knee-jerk reaction to it. It's more often than not wrong. And it may take a day or two for that to show up, but more often than not, it's wrong. So the initial move, that knee-jerk reaction, stocks are not a good place to kind of actually see what the market thought. So we're looking at the dollar index here. It's a 4-hour chart. As soon as the dollar index topped, this was tightening, tightening, tightening. This is basically peak inflation, peak Fed hawkishness, not a pivot, but peak hawkishness. And as the dollar comes down, what you see, and that's basically in September, it started coming down. You see the market start to rally in October. So since the dollar has basically been a proxy for what the market thinks the Fed's going to do and inflation. So as the Fed was hiking rates and we're seeing the dollar go higher, it's just reflecting that. When we see the dollar actually breaking down, that's when we get that rally that started in October. That's 6 months old now. Okay, so this is going to be a very important level. It's just below, for the US dollar index, it's just below 101. Kind of looks like a little double base. So this is what I'm going to be watching on Wednesday at 2 o'clock when we get the FOMC announcement, and then Powell's press conference at 2:30. So basically, like a quick rule of thumb is if the dollar moves up on that, it's a more hawkish take of the meeting, the policy statement, and the press conference. If it moves down, it is more of a dovish take. The dollar has had a very, very strong inverse or negative correlation with stocks. So if the dollar rallies from here, and a couple ways that could happen is the Fed is more hawkish than the market has priced in, or we get resurgent inflation. That is going to be bad for stocks. But if it breaks down below this level, and I think it's about $100.70, just below 101. If that happens, if it breaks down, Fed is more dovish. That's going to be very helpful for stocks. We can extend this rally a little bit. Sorry, a little water break. And show you that relationship. So hope this isn't too confusing, but what we're looking at now is a 2-hour chart. Oh, hey, Jen. Thank you for the super chat. Very cool. Jen is actually very savvy about the market. She's less technical and more intuitive, but very savvy about the market. In any case, we have S&P futures here in the red and green candlesticks, 2-hour, and the US dollar index. But I've inverted it, so what you can do on Thinkorswim is put up a comparison line, and then for the US dollar index to invert it, put minus sign, dollar sign, DXY, and that will invert the US dollar index. And it will give you an easier way to compare. So what you see over here is the dollar actually getting stronger at these kind of February highs, right? And that's when we got all that hot inflation data in February. The dollar in getting stronger was reflecting that. It led the market lower. Over here mid-March, we have a higher low, or actually we have a lower high in the dollar because it's inverted. And we get that kind of mid-March rally up to where we are now in this consolidation. So in my view, I think we're pretty much where we should be, equilibrium between the dollar and the S&P futures. But this is going to be really crucial to watch next week. Again, watching the dollar index here around this, it's just below 101 for the US dollar index. That's really going to be key to watch as we move forward into next week. And I have one more chart. So I want to talk about what my expectations were last year when we were still in a bull market. And I had my 3 phases, right? So if you're a subscriber, you know what those are. But phase 1 is basically the market rallies on not necessarily a Fed pivot, but that peak hawkishness, okay? Phase 2 is basically the market is getting worried about recession, and that's where I think we're at risk of the market making a new primary trend lower low. Now, we're nowhere near close to that yet, but I think we're late in the 9th inning of phase 1. So phase 2 is the recession. And let me move down to the next chart. So the point of this is my whole thing was I do expect the market to rally, and I'll show you why. Let me just go to this chart of IWM. If you look back in the year 2021, you had the market rallying, right? S&P making all-time new highs, and you had IWM, or the small caps, doing nothing. They're domestically focused in the US, right? Mostly US stocks. Smaller US stocks, a lot of value, a lot of banks, energy, stuff like that. There was only basically a 2-week period out of that whole year where it looked like maybe small caps were going to participate, and that was right over here, and that failed. But before that, we basically just had a lateral range going sideways. So all of 2021, the small caps weren't confirming. I like to see the small caps lead, and what they were actually doing was leading in showing weakness compared to the S&P or the Dow or the NASDAQ. Here is coming into 2022, and that's our bear market. So these red circles, what you're seeing is a primary downtrend. So I don't judge a bear market by the media's definition of 20% off of the highs, because it's just very arbitrary. It depends on the asset you're looking at. 20% for Tesla can be like a standard pullback that means nothing. But when you're talking about something with lower beta, it's just not the way I would classify a trend. So I lean more towards Dow theory, where the primary trend here is lower highs, lower lows. So bear market right here. My first inclination that something was going to change was August, when we got this first higher high. All right. We didn't get a trend change, but we got something transitional. That's when I started talking about looking for a base in October. Now, small caps had a very similar base to the Dow, which was kind of like a double bottom right here. But all I expected was an intermediate trend. The primary trend is like the main trend. Intermediate trend lateral. And that's basically what you see in this blue shading, right? It's a lateral intermediate trend. That's all I was expecting for phase one. And then phase two is kind of what I think, where I'm leaning towards, is a breakdown to a new primary trend, lower low, and that bear market reasserting itself, if that makes sense. Let me take a quick look at the comments again. Thank you, George. Go viral. Hey, Dennis. I was scared of the market during the shakedown on Wednesday. I'm now playing USO with puts, but it rallied harder on Friday. Do you think it's still in a bear flag? Yeah. So let me pull up USO. I'm going to transition this chart for you guys in just a second. Find my trend lines. Here we go. Okay, so transition this so we're all looking at the same thing. So I'm using USO here as just a proxy for crude futures. And what I see looks deflationary to me. So over this past week, we saw a lot of signals that were tending to be more deflationary. When I say deflationary, I'm not necessarily talking about we're going to see this huge, just automatic drop in inflation, like a waterfall drop, but deflationary in terms of the market looking more toward the potential of recession. Capital One came out this week and they said they expect a recession in the second half of this year. What have I been saying since last year? This time, not this time last year, but summer. I've been saying that my gut feeling is that we get a recession probably the second half of this year. So stuff like oil, commodity currencies like the Aussie, stuff like that, you'll see start to act badly. The yields on treasuries this week were largely down. They're down on the week. But yeah, so we do have a bear flag here in USO, and it started out as a small bear flag. So what I'm thinking, a lot of times what you'll see is these smaller bear flags, and then you'll get a big consolidation. So it's too early to say yet. It's not obviously going to be a small, tight bear flag like this, but we might get something that basically, and I'm just kind of going to future cast this a little bit. We might get something that looks like this, where we get a bigger bear flag. And instead of our measured move target being from here down to here, it would be more like the breakdown of this whole thing. So it's something to watch. I think it's expanding. I see this a lot, especially when we get like a bear flag on an intraday basis. It almost always expands into something bigger. So it's still on the table. We'll have to see if it comes down, hits this trend line, and if that does, then we're looking at a much higher probability of a bear flag there. So I hope that answers your question, Dennis. But it wouldn't surprise me to get a bigger bear flag here. It wouldn't surprise me at all. I often talk about, in the middle of a measured move. So let's just say this was our measured move. I often say this, about halfway between, you'll get a consolidation. In this case, a bear flag. So if it was a bullish, let me pull up the NASDAQ 100. So if it's a bullish consolidation, you'll get the bear flag or the bull flag or the consolidation about the midway point. So I think that may be what we're seeing in USO or in crude oil. We may be seeing a bigger flag developing there. But what you do want to watch is for confirmation of that trend line. And did you see how I made that trend line? So I just connected the bottom, right? I would say 90% of the time, all you have to do is make that exact same trend line and move it. They have a really, really strong tendency to have symmetry. So let me get rid of this. And I think my last slide, let me pull that up on PowerPoint. And this is going to go to the notion of recession in starting the second half of this year. And what we are looking at over here is GDP. So GDP missed this week. I think it came in at 1.2. They were expecting 2. Remember last year, we did actually have a recession. A technical recession is described as 2 quarters of negative growth. As soon as that happened, it was like the White House, the Fed, everybody that they could muster was out there, economists talking about, no, this isn't a recession because the labor market is too strong. Let me tell you something. The labor market is the absolute worst indicator for as far as leading indicators go for the economy. It is the worst. Most of the time, you will be in a recession. You will already be in it before the unemployment rate starts to rise. And then most of the time, you'll be in the start of a new economic cycle, a new bull market in stocks starting. That's my phase 3, by the way, before we start to see them hiring again. And usually by 6 months. So it is the absolute worst. And that is the argument they were making, that employment's too strong. It was a really crappy argument, but we did have 2 quarters of negative GDP consecutively. And that's pretty much always been basically the definition of a recession. But unless, the FER says it's a recession, they don't classify it as that. But in any case, you can see GDP coming down. And surprisingly, the Atlanta Fed's nowcast got this right, the 1.2. In any case, that's kind of my view that we're going to have something like a recession starting, at least starting, may not be in a full blown, like both Q3 and Q4 or Q2 and Q3 being recessionary, but I think we'll be moving towards that in the later part of the year. Let me take a look at questions real quick. And I think we can look at a couple 3C charts. Now, I'm going to just forewarn you in advance, 3C charts have been really dull. That's why I haven't been featuring them, because it's been such low conviction. And again, if we go back to any of the averages, like the S&P 500, I'll pull that up for you in just a sec. Okay, and let me transition that over so you can see it. So again, we have just very low conviction in any of these averages. Earnings season, part of that. But we have also seen some changes in character or tone in how price is acting. So my point is, during this, there's not a lot of conviction, so there hasn't been a lot of interesting signals on 3C charts. We haven't seen traders really accumulating or distributing. They're just kind of floating in there and waiting to see what happens. So I'm going to pull up a couple 3C charts first. Let me transition that so we're all looking at the same thing. I think I'm getting better at transitioning this. First couple live streams, I would talk for like 15 minutes about a chart. You guys couldn't even see it. So here we go. That's the diamonds, the ETF for the Dow, and 3C in orange. We have a 2-minute chart here, and it's pretty much kind of confirming. It's kind of moving along with price, not really doing a whole lot. This is why, I haven't really featured too much. I suppose you could say there is a little bit of a positive divergence here, relative positive divergence as we came into this low, but nothing that's really jumping off the charts to me. And that's what I say, is it jumping off the chart? The thing you don't want to do is torture the charts to tell you something. And a lot of times, because it's an emotional thing to have money on the line, to be at risk, you want to see stuff that confirms your position. And bias sneaks in really easy. But what I always say is the strongest things, the strongest signals are going to jump off the chart. And when they do that, that's like when I like to get involved. Okay. So let's go to small caps. I'm going to put on IWM. So remember I was talking about this inverse head and shoulders potentially kind of base in here. And we do still have this kind of decent accumulation. So we definitely did see traders buying in here. Hasn't worked out great yet. We haven't seen a leading divergence, but that's kind of still there for IWM. But if we look at the more recent activity, and I'm going to go down to a 1-minute chart, and just understand, like, this 5-minute chart is a stronger 3C signal. It's pretty much been the one I've used to track this rally trend from the October lows. But if we go to the 1-minute chart, you could see it's just not great. Over here, you get a little bounce, no confirmation in 3C. 3C should, if it was confirming, it should make a higher high with price over there. Coming into this week over here, you can see it's just not small positive divergence here and like a relative negative divergence here. So again, not jumping off the charts, not telling us a lot. Let's take a look at the SPY real quick. Now, this is interesting. Remember, we got that pullback from February. We started with a bull flag over here in the S&P, and that fell apart, right? And it just became a channel, and price still respected that channel, so I kept it up. But as we come into these March lows, a nice positive divergence. We get a little rally, but over here, we kind of have a relative negative divergence. We're not getting a lot of confirmation. And in the near term, it's kind of the same thing. So this is an interesting thing. We have this mid-March rally, right? 3C is leading here up to the upside, which at that time, when it looked like a bull flag forming, looked great. But since then, look what it's done. It's kind of come down, and we've just been in this blase range. So this isn't a horrible signal. It's not like, hey, I would go out and short the S&P right now, but it's definitely a change in tone, a change in character. We do have a higher high over here relative to back here. 3C is not making a higher high. So again, just really low conviction, which is what the price patterns of those rectangles are telling us as well. And then let's jump to QQQ on this 1-minute chart. This was one of the interesting things that as we came into the lows, remember that, what was it, a rectangle over here, and I said we had like a little head fake where prices dipped below and some shorts could have jumped in, and from these failed moves come fast reversals. We did have some accumulation of that low over here. So as we've gone through this last week with earnings and the market's starting to get like a composite view of what earnings look like, with 45% of S&P companies reporting just last week, it seems like the market has said, well, you know what, we looked at it and we're going to stick with these mega caps. So we see pretty good confirmation here in QQQ, and I'm guessing, if the market does have more rally in it, it's probably going to come for these mega caps, for the rest of the quarter, Q2. What else do I have for you? Oh, speaking of mega caps, let's go to the tech sector. Let me zoom this in for you a little bit. So this is another interesting thing. What I always kind of try to point out is, a negative divergence doesn't necessarily mean that it's bearish. You can see kind of this equal low here with a little head fake below. That's accumulated positive divergence. We get this little rally. Here we come into the consolidation. It started as a bull flag, just like for QQQ. Actually, I believe this one stayed in a bull flag. I have not come up with a name for this kind of divergence. I don't see them a lot, but they're very powerful. So it's almost like this parabolic It's really a relative divergence here, but it kind of gets parabolic. So it's like if I had a drawing tool, it would be kind of like a round shooting up here. So that's the tech sector, the most heavily weighted sector, the most influential sector. And that's a good signal for tech. I'm going to pull tech up for you again real quick. And TC2000, or yeah. And again, so what we see is this bear flag. There's that little head fake that I showed you was accumulated, and we're getting this little breakout. Okay, so tech, in my opinion, um, looks pretty good still. And I think what the market is seeing is after this last week, they feel more comfortable with tech. So I'm going to go back to TC2000. And this is a short term, basically 1 minute chart. So here again, you see that little head fake accumulated, right? Squeezing the shorts, and we get really good confirmation towards the end of the week. So it's like we saw the tech earnings, and they look better than most everything else that we're seeing right now. Tech is largely secular growth. The mega caps are largely secular growth, meaning they don't rely on the economic cycle as much as like the cyclicals, like materials, industrials, financials, stuff like that. So I think XLK tech is coming back into rotation after the market has kind of seen what earnings look like. And I think it looks pretty good. One more I want to show you real quick is high yield credit. And the reason why HYG is a very deep liquid product. I'm going to transition back to this chart, and we're looking at HYG. So what happens a lot of times is institutional traders will use HYG as a proxy for S&P futures. Okay, so the reason I like HYG is because it's a window into what institutional money is doing. And what we have here is kind of a big ascending triangle. Remember, I talked about this early in this live stream. We have an area of resistance, but this rising trend line, every time price dips, buyers are getting more aggressive. They're buying earlier on these dips. And that is why this is a more bullish price pattern than a rectangle. And if we go to HYG's, just flip my page here, HYG's 3C chart, pull that up, and I'll transition you over to that. We have another one of these interesting divergences that I just showed you on XLK, the tech sector. So here's HYG's 3C chart. Here is that consolidation that we were just looking at. And here is that kind of parabolic. It's not quite as strong as the tech sectors, but still it's got this kind of ramping parabolic look to it. If anybody has a good name for this kind of divergence, basically I have relative divergences, relative to price. They're good, but they're not the strongest. The leading divergence would be stronger, but this one where it kind of swoops or swishes up, it's a very strong signal, and you don't see them that often. So that's a good thing that we're seeing from HYG. So I don't think this rally's over, but I am getting the feeling that if the Fed comes out and gives what the market thinks is good news, the dollar drops, stocks rally a little bit into that. S&P maybe goes over 4,200. The shorts get squeezed. I think what we'll see is institutional money selling into that rally, into price strength. They don't want to sell into price weakness because they'll crash the position that they're in. They want to sell into price strength. So that's what I'm kind of leaning toward. And other than that, I think I covered everything that I wanted to cover. We're seeing changes in character, not changes in trend, but changes in character. So again, not every change in character leads to a change in trend, but when you have a change in trend, you almost always have a change in character that came before. So if you pay attention to the market closely, you'll see those things, and it's a huge edge, huge edge. Let me look at comments real quick. XLE possibly turning up. The energy sector. Not sure, George, what time frame? Oh, weekly, turning up weekly on a weekly chart. Give me just a second to clean this chart up a little bit. And I'm going to transition it over. Okay, let me transition it over. So this is a weekly chart. You can see 2020 there is the COVID crash. And then, we basically, this was a recession, right? Remember? COVID crash, I showed you the gray shading over here, the recession shading. So we were coming into the start of a new economic cycle. The cyclicals are where you want to be when that happens. We're not there yet, obviously. But that's what we were seeing was strength in energy. But over here, I'm not thrilled about it. Just taking a little closer look. Let me go to a 2-hour chart. I mean, it is possible that there's like a little bull flag here. It's possible. But and it's possible there's a big bear flag here or a bull flag here. But when they get this big, it's just I don't consider them valid. The typical bull flag is like a 3-week pattern or something. What is important about a bull flag is that you do have it's a consolidation continuation pattern. So the continuation is, it's like you have a rally, it's taking a rest. That's where you want to see a bull flag. It's taking a rest and getting ready to continue that pattern. Not much of a rally here. This looks more kind of range bound, choppy to me. Just knowing where we are in the economic cycle, energy is not my favorite, and it's pretty lightly weighted sector, so it's not going to do much for the S&P 500 like the mega caps are going to do. Let me see. Any other questions? Hey, Patrick. Market has been resilient. Yes, it has. Slowly coming around to the bull side. Slowly coming around to the bull side. Ooh. Once broken on the upside. Central banks easing up. Yeah, okay. Bank crisis earnings. Debt ceiling. Okay, so the debt ceiling usually is you'll get a lot of play on that from financial media about the debt ceiling. But 9 times out of the 10, it's just kind of a flash in the pan thing and just kind of a lot of fear mongering. But in this particular one, U.S. sovereign debt is at like all-time record highs. So there's definitely some concern about the U.S. having a technical default on bonds. Maybe that's part of what we're seeing with the skew index. Let me change this to a line. So the skew index, it's a CBOE product. Oh, I need to change the line here. And basically what you can think of it as is the black swan index. And what I've noticed recently, so I guess around 110 to 115 is kind of like the normalcy area, in here. It used to be around 135, 140, you were getting into like hairy zone. So the more this moves up, what it basically is reflecting is traders or hedge funds or whatever buying deep out of the money puts as protection, as a hedge. So the higher this goes, it's kind of reset now. So if you look at the original CBOE white sheet on skew, I think the historical, when they put it out, the historical high was around 150. Now we kind of routinely see highs above 150. And what I want to point out to you, remember that the 2021 bull market peaked right at the start of January 2022 before we went into a bear market. And what I was pointing out at the time, we had the Santa Claus rally, people were bullish, all-time new highs for the SP, all that stuff, right? But what I was pointing out was back in December over here, over 150. This is like red flag, red alert, sirens blaring. So you had traders just looking at the S&P making all-time new record high, very bullish. And what happens? We get into January and we start a bear market. So basically what you were seeing was smart money, above this 150 area. They were hugely hedging downside risk, right? And then we moved into a bear market. So what I'm seeing is, yes, we are seeing the skew move up a little bit. We're seeing more hedging against that downside risk. It's not at red alert levels yet, though, but that's something to watch. The FRA OIS spread, that's something to watch too. But again, my view is that we are probably ninth inning of this rally, which has been 6 months. Most bull market rallies aren't 6 months long. And again, let me go back to that one chart of IWM and switch this over. It is exactly what I was looking for last year. A lateral price trend. Moving from, now that's an improvement over a bear market of lower highs, lower lows. This was the first transitional thing in August. This was when I first started talking about we could see a transitional trend. Then as we got into October, all the averages were making different kinds of bases. The Dow had a W bottom here that also linked up over here. Small caps had the same over there. S&P was a little bit more of an inverse head and shoulders. But in any case, we got these 20% rallies in just about every index, but we got that intermediate lateral trend. That's all I was looking for. I wasn't looking for a base to start the new bull market. So we've kind of done what I was expecting from the market. And let me just pull up one more chart for you. S&P 500. Let me take off trend lines. We don't need those. And let me transition it. Oh, I'm so happy that I'm like transitioning these charts and not talking for 15 minutes and you're looking at the wrong thing. A little bit of time and experience. So my guess would be, now look, if we made a higher high above, this August high, then we have something really interesting happening and possibly a trend change from this intermediate lateral trend. But kind of what my theory is right now is that while the Fed is going to talk tough, Powell's going to talk tough, I think they probably won't hike rates again. So if that's the case, and we see the S&P break out above 4,200, my gut feeling is that we will see smart money, institutional money, big guys use that price strength to sell into. Now, that's a gut feeling. We don't know until it happens. But when it happens, or if it happens, the S&P moves above 4,200. And we're seeing 3C charts not confirming. We're seeing heavier signs of distribution. At that point, that is when I would want to sell into strength and get in on the bear side and maybe short some stuff. And then if you're not comfortable with shorting, there's other things that you can buy. Treasuries, euro dollar futures, but they may have a little longer time horizon because, going to be looking for the Fed to eventually cut rates because of the recession. They don't want to do it right now because they don't want to make the Paul Volcker mistake where he basically raised the Fed funds rate in the early 1980s, I think to 19%. Inflation started to come down, but we had a recession. He got political pressure. He cut rates too soon. Inflation resurged, had to raise rates again. The Fed funds rate, I think, went up to almost 20%, early 1980s. Another recession. The Fed is terrified of making that mistake. So I think they'll talk tough, but I don't think
they'll hike again. That's my take. And if that is the case, then you're going to see probably some FOMO and some chasing of prices above 4,200. And I think you'll see the pros selling into that. So that's kind of my spiel. That's kind of my wrap. Any other questions? Let's see. Let me see. Dennis, what would be the effect on bonds in the event of a default? Yeah, we haven't really we haven't really had one, but I just know the sovereign risk is going up. I mean, the United States, dollar's still king. Our treasuries are still, you know, viewed as bulletproof, but I don't think it would be great, but I'm just not too. I think they will absolutely come to some kind of a deal, but in the meantime, they're going to saber rattle and they're going to make a big stink about it, fight about it, and blame this one and blame that one. The Democrats are holding it up and potentially causing a debt default, and then Democrats are going to blame the Republicans, and a lot of kabuki theater. Um, Normally I wouldn't even mention it as something that's on my radar, but because US sovereign debt risk is at all-time record highs right now, I think the market is taking it more seriously. So it's something on the radar. So it's something to watch, but ultimately I think it probably ends up being a flash in the pan. But of all the times I've seen this, this is probably the most serious. Patrick. So much debt to roll over. I think cap central banks actions tightening long term. So, when the Fed hikes rates, it takes sometimes 6 to 12 months, for that to actually manifest and show up in the economy. So, a lot of the rate hikes they've already done haven't hit the economy yet. So, things are going to get tighter. Um, and I think that's why they'll probably just do one more hike and that will be it. The bond market is telling them again to stop. Let me just go back to that chart real quick again. And you can bring this up yourself on St. Louis Fed's website. But again, recession shading, Fed funds rate in blue, 2-year yield in red. You could see the rate hike cycle. You could see the 2-year yield cross below it, and the rate hike cycle ends. They eventually start cutting. Here's the recession. So we're at that point again. You can go back to the financial crisis, 2008, right? You'll see the same thing. Um, Fed was raising rates. I think it was around 2007 this happened, this cross. You could see it in the dot-com crisis. It's just a very, very high probability. Um, I think last weekend's video I showed all the examples, but I think the Fed is probably done with that. Dan the Man Tesla. I don't follow Tesla a whole lot as a stock itself, as part of the mega cap index. Let me just take off a couple things here. Possibly a bull flag. Let me switch this over. But it's not. It's a little bigger than what I would want to see in a bull flag. So possibly a bull flag here. It's a little bit bigger. It's a little bit sharper. If that does turn out to be a bull flag, and the more confirmation points we can get at the pivots, the higher the probability. It looks like probably 200-day is going to merge with whatever this upper trend line is for that bull flag. But you would basically have a measured move. If you have a bull flag this big, you'd basically have a measured move. I'd have to really break this down to see where the breakout is, but let's just take it from there. You'd have a measured move of about, that's huge, 85%. So it'd probably, let's just say it broke out somewhere around here, and you'd add that 85%, which would be, up around here, and then we'd be coming into a lot of overhead supply again. But if we're moving into a recession, this is the kind of stock, consumer discretionary, that usually gets hit. Tesla acts a little bit different. It trades a little bit like more like the mega caps because it is a mega cap. But just because of where I think the economy is going, cyclicals aren't going to be my favorite stocks moving forward. The secular, believe it or not, the secular growth mega cap tech stocks tend to do the best in a recession. Now, why did they do so horrible in 2022? It's because it wasn't just a typical recession, it was inflation. And the Fed was hiking rates, and that meant all these companies that have very forward looking valuations, because after Amazon, when there was a point when people were debating whether or not Amazon could compete with Barnes and Noble, back when Amazon was just selling books. So after everybody got burned on that and saw Amazon, oh gosh, I should have bought Amazon. They started giving these stocks a lot more forward-looking valuations and a lot higher valuations. So in 2022, when the Fed is hiking rates due to inflation, all that had to be discounted. And you could see what happens here. Here we are in 2022, and what was it, about March, I think, right? That the Fed started cutting. Butterfingers again. Let's do it this way. 72% decline. So I could take a closer look at Tesla and post this on the website if anybody's interested. But again, it's a cyclical. So not going to be my favorite as we move into a recession. You have the January 200 put. Yeah, I mean, the only thing, like I said, I don't like to see big bull flags like this. Let's see if we can pull this up on this chart and get a little closer look. We're going to have to go to a 2-hour. Again, remember what I said. Yeah, I mean, this is kind of even a little sloppy. Let's see what we get. Watch what I'm doing. Parallel line. 90% of the time, that is what you're going to get. So yeah, it does look like a big bull flag. And then that breakout area would probably be, I would say, above 210 to be safe. But really, you want to get above this high. So right now, it looks okay. I would say if you see a move right here and it starts to break out and then it comes back in, then you get this higher potential of a bull trap. And from failed moves, this is not a very big one. So the bigger it is, the more bulls it's going to suck in, because they're looking at the same thing. They're looking at these trend lines. And when they see that breakout, they're going to jump in. So the bigger it is, then the more potential for a bull trap. But basically, if you do get a breakout here and it kind of fails, a lot of times you'll see a very fast reversal and those puts would be looking good. But right now, it still does have that kind of bullish bias. And that's the same thing. Let me get it out of this real quick and go back to the mega cap index. And there we go. Let's have a little fun and just compare Tesla. A color you can see. So Tesla, right? Much higher beta. So it looks really crazy here. So I'm just going to take it off of that normalization. So if we're just looking at it from January, where the mega caps rotated in, remember before January, these were the dogs. The mega caps were horrible. They were the dogs. But January 3rd, right here, you can see Tesla moving along with the mega caps because it is a mega cap. But it's still got a very, very big pattern. So this to me is an ideal bull flag 3-4 weeks, but when you're getting into a couple months, still has a bullish bias, but it's not my favorite. So the tighter the bull flag, the lower the volatility, like a little pattern like this, the more explosive they tend to be. So you can see Tesla kind of lagging on a relative performance basis. I know they've been doing a lot of weird stuff with like lowering prices and then raising them and all that, but I don't usually follow the specific companies, but the actual sectors, and then you can either trade the sector. I like to take as much unknown risk out of it. So unknown risk is, does Tesla come out and cut their prices next week and then raise them and then cut them? Do they miss on earnings? So I prefer to try to mitigate that kind of stuff as much as I can and trade, something like the mega cap index instead. So when I was saying, in December and actually way before that, that I thought the mega caps were going to rotate in, you're not going to get generally as big of a price move in an index like this, MGK, or an ETF, that you would in Tesla, but you are mitigating a lot of that unknown risk that is specific to the company. So I hope that makes a little bit sense. And you know what? I'm going to wrap it up. It's been an hour and a half. I'm glad everybody joined. Thank you so much. For members, you know what? I am going to see you tomorrow morning. If you do have questions or comments, please leave them in the comment section. This live stream will take about an hour or two to process, and then YouTube will post it so you can watch it again if you like. Until then, thank you very much for joining me. Questions, comments, again, leave them down there. Don't forget, hit the subscribe bell at the bottom right, or the subscribe button bottom right of the chart. Don't forget to hit notifications so you are given a notification before something like this live stream comes up. Thanks again, everybody, and